Hello everyone, Douglas here, Ken of Market Analysis, and today I want to talk about the recent sell-off in the markets and the rise in volatility that we're seeing and what the cause is behind all of these happenings and why I think we could be setting up for a very similar situation to the sell-off that occurred on Black Monday in October of 1987. So if you like this video, make sure you hit that subscribe button, click the notification bell as well so you know right when the next update is posted. And then don't forget to give it a thumbs up on your way out as well. So what I want to do in this update is show you a tool that I think will help illustrate to you all why we're getting such vicious sell-offs and spikes in volatility. And I'm thinking specifically of the early 2018 sell-off that occurred, and then the sell-off which occurred just last week. Okay, so just to lay some groundwork here before we move forward, the underlying reason for these sell-offs, or I really should say that the market conditions that have created the environment for these sell-offs to happen, all has to do with a massive growth over the past decade of the short volatility, short gamma trades. The largest of these strategies being risk parity. And by large, I mean, from a lot of estimates I've seen, well over $1 trillion, $1 trillion is being actively or really passively managed in risk parity or risk parity-like strategies. Okay. Now, if you're unfamiliar with what risk parity is, or if I'm not, this isn't exactly making sense quite yet, hang in there. I'm sure it's going to make sense in just a second. So what I've brought up here is an Excel spreadsheet that will allow us to construct a risk parity portfolio, and in doing so, we're going to kind of see all the mechanism and how this all gets put together. And if you're interested in following along at home, you can download this portfolio, and I believe the website is portfoliowizards.com. Thankfully, they were kind enough to put this together and put this out there, which saved me a lot of time having to build my own. And this thing works quite well. So I'll put the link in the description below, and you can download this. And there's some instructions to get everything to work right, but just follow through them, and you should be able to replicate everything I'm doing. All right, so what is risk parity and what's happening here? Well, the idea behind risk parity is that instead of deciding to allocate a portfolio based on the actual capital, you're going to allocate a portfolio based on risk. And the idea here is to minimize volatility within a portfolio. Risk parity gained a huge popularity after the 2008 financial crisis due to the fact that this approach fared very well during the kind of heaviest sell-off periods during the GFC with relatively minimal drawdowns, all things considered. So the idea is to calculate the volatility for each asset class or each asset in your basket, and then equally distribute that volatility amongst the asset classes so that the actual capital allocation is proportionate to the risk involved in holding that asset. And you can see here just right now with kind of the base that we have, the risk weight is what's equal here, and then in this tool, and this will make more sense as we build it up. Then this tool shows you what you should actually weigh from an actual asset allocation or capital allocation proportionate to the risk. Okay. Now the other large component of risk parity is correlation between assets, and here the idea is to offset the risk built into the correlation. In other words, highly correlated assets are going to be riskier because they will move together. So if you get a spike in one, you're going to get a spike in the other. And again, doing the same thing based on capital allocation proportionate to the correlation. So correlation in this model is a much smaller piece of the puzzle, but it's still a very important piece. All right, so what the spreadsheet is doing is it's going to put together a classic risk parity portfolio based on classic risk parity equation, and then solve for the equally weighted volatility and correlation. Let's see, and thankfully the inputs, which are going to be on the inputs tab down here, are readily available on the web. So I'll show you the sites you need to go to get those, and we can build this up. So let's go ahead and do that. I'm going to pop open this website right here, which is, whoops, sorry about that. We'll go back to it. There we go. Which is portfoliovisualizer.com. You just go to the asset correlation tab, and we're going to put in 3 assets here. We're going to put in the SPY to be our equity portion of it. We'll put in the 10-year bond, or 7 to 10-year bond ETF, IEF, and then we'll put in a commodities ETF, DBC. Run them for as long as we can. Most of this stuff doesn't really matter. You can tinker around with it and get very similar results. Click View Correlation, and I have it calculate for us. And so now we have the correlation inputs that we're going to need for our spreadsheet here. So what we're going to want to write down, and I already have these written down to the side off screen, but what we're going to want to write down is the correlation between the bond and the SPY ETF. So we're at a negative 42 correlation there. And then we're going to want to write down the correlation between the commodity and the SPY ETF, so 44, and the commodity and bond ETF at 23. And we'll bring those back to our model, and we'll go ahead and type those in. So we are at negative 0.42, 0.44, and negative 0.23. So we're good there. Our correlations are set between the 3 asset classes. Okay. Now the next thing we want to do is pull up the volatility, and again, we're just going to find a website that does this for us. And there are many different ways to measure volatility. Again, for what I'm trying to express with this update, it doesn't really matter if we're using the most precise or the best. We just need some volatility measure, and the annualized volatility is going to be good enough here. So we are going to grab we'll type in SPY and grab the SPY volatility, so 12.5%, which I've written this down, so you'll want to write this down as well. 12.5%. IEF for our bond ETF, 3.8%, and finally DBC for our commodity ETF, and we're looking at a volatility of 12.5% as well. So we'll jump back in to our risk parity tool, and we will update our volatilities accordingly. So it's going to round up to 13, no big deal there. 0.038, it'll round up. Oh, that one didn't round up. That's goofy. You know what? I think it's supposed to. So just to ward off some headache, I'll go ahead and do it for it, and we'll do 13 as well. So then what we want to do is we want to go back to the results page, okay? And you're going to need, part of the instructions is you're going to need to go ahead and enable the solver add-on for Excel. We're going to click solve. We're going to solve for the equation, and we're solving for the risk weight here, and that's what it's doing. And we'll click solve. It'll say, do you want to keep the solver solution? Yes, we do. And notice how the very first thing it's going to do is it's going to rearrange our chart here to ensure that the risk is equally weighted. So we're now weighted 33%, 33%, 33% across the board. And it's going to show you the corresponding asset allocation from a capital allocation side that you would want in this situation, right? So you're going to want 70% stock, just shy of 69% bonds, and 14% commodities. All right, and this again, and this is in this specific setup with these sort of inputs for volatility and correlation. And yeah, I mean, this is pretty classic. This is kind of what I'd expect in this situation. Relatively heavily bonds here, relatively low equities and commodities. And so yeah, this is your classic risk parity breakdown here. Now to kind of move forward here, remember I said there are 2 big variables here, right? Volatility and correlation. So we can start to play around with these. So let's start with the less impactful of the 2, correlation. Okay, what we're going to do is we are going to increase increase the negative correlation between stocks and bonds and see what happens to our capital allocation here. So instead of negative 0.42, just as a reminder before we go ahead and do this, 17% is where we're at right now. And let's bring this to 90% negative correlation, meaning essentially there's a 1-to-1 correlation, negatively speaking, between stocks and bonds. Stock move an inch, bond moves an inch, percent, whatever you care to call it. So anyway, go ahead and move that. We're going to go ahead and solve again. Yes, we want to do this. And notice how our stock correlation, our stock allocation has jumped from 17 to 21%. Okay, so as the correlation deepens between the two, negatively speaking, the volatility, the assumed risk, if you will, is going to be less for the SPY because you're going to have a greater offset for the bond here. Okay, so you're going to increase your stock. All right, and if we were to completely reverse that, and let's just do this now at a 0.50 and solve. You're going to get a drop. So now we're down to 14%. Okay, exactly what we'd expect, because now the risk is increased because the correlation is higher. Okay, and this is exactly kind of what we'd expect, and this is what we've witnessed very much over time, right? Stocks go up, bonds go down, and vice versa. Okay. And yeah, I mean, this is again all kind of classic stuff, and we'll get to the point where it gets fun in just a second. So let's reset to where we were actually at the beginning, negative 4.42. We're going to solve for that one more time, and again now we're back to our 17%, 69% stock bond, and then 14% commodities here. So let's now look at the more impactful component, volatility itself. Okay. And let's jump to the inputs, and let's say we bring volatility down closer to where it was in the late 2017 run up before the big sell off, right? Well, let's say instead we mark volatility at 0.05. Okay, so we're bringing volatility of stocks way down, right? Very close in line to bonds. All right. Well, what happens? Well, it's going to increase the risk, relative risk of bonds, and decrease the relative risk of stocks. And of course, hopefully you can guess at this point then that we're going to increase our allocation of stocks. Okay, and this is because with the volatility lower, that according to risk parity, it has a lower risk to the entire portfolio. Okay, so you have to increase the equity position. All right, and this is really important to understand. Okay, is that as volatility decreases, that means the risk decreases along with it. As volatility increases, that means the risk increases along with that given asset, and its equal weight, risk weight across the total allocation. Okay. And really herein lies the fatal flaw, if you will, with risk parity and all like trading strategies based on this very similar concept. And that is that volatility does not equal risk, and risk does not equal volatility. And just to kind of think what has happened now in time, right? So over the last decade in risk parity, as equity prices have risen, okay, this is important to understand here. So over the last decade, as equity prices have risen, it has lowered the volatility of these equities, right? And when the portfolios have to rebalance, and as new money comes into these funds, they call for more buying of equities, which in turn lowers the volatility because it's pushing up the price as more buying comes in. And this creates an inevitable positive feedback loop, right? It's driving up equities, driving down volatility, driving up equities when more purchasing and rebalance has to come. That drives down the volatility. And remember, I told you at the start of this video that there is well over $1 trillion that are currently in these funds and being invested. And why that's important to understand is that these funds, they're obligated to rebalance according to their set rules. It's an algorithmic trading mechanism. It must buy equities when vol is lowering, and on the flip side, which is what we're going to get at, it has to sell when volatility is rising. So you can understand the massive buying and selling pressure, but primarily the massive buying pressure that's occurred over the past decade, which has helped drive equities even higher and higher while driving volatility lower and lower. Of course, something major changed in 2018, right? And that was that we had a major volatility reset. So I'm going to pull up the VIX here real quick. Take a look at that. And notice that on the VIX, with a mild exception in 2016, the VIX made a constant kind of lower low, lower high for nearly an entire decade. And then finally here in late 2017 into 2018, we had a major, this all changed. We had a major reset. And now we're in the midst of a sell-off from a much higher volatility starting point, if you will, meaning equities, when they need to get rebalanced, will be forced to sell, which is exactly what we happened during this saw during this most recent sell-off. Okay, and this is why, and I'm going to switch to another chart real quick. Unfortunately, they don't have this fund in TradingView, so I'm going to have to pop up stockcharts.com real quick. But this is exactly why risk parity funds like AQRIX are having a terrible year so far. It's because the volatility reset itself back during the January and February sell-off, and it forced risk parity funds to increase their bond allotment and decrease their stock position. So when stocks continue to churn higher throughout the year and bonds push lower, it really shredded these funds. And here's really where things get even more interesting. Okay, and I'm going to jump back to our tool real quick. Okay, so here's where things are getting even more interesting. The Federal Reserve has made it very clear that they intend to continue to raise interest rates even past the natural rate. And remember what I said about correlation, right? Remember what we noticed about correlation when we were playing with this tool, that now that we have bonds selling off and stocks selling off, that's a sudden reversal of that correlation, right? And what's happened to our risk parity model when we go from negative correlation to positive correlation, and we saw this earlier, right? We were forced to sell stocks when we rebalanced, right? We had to reduce our equity asset allocation, okay? And this is exactly what is happening in the markets today, okay? To a T, all right? This is why we're seeing these sudden sell-offs, right? And it's really because so many of these funds are now in such an identical position, okay, that it used to be that the targets for where these sell-offs might occur would be a broad range, so you wouldn't have, billions having to be sold in the market. Well, we're getting to a point where kind of the margins, if you will, or where these targets are for the forced selling, for the forced rebalancing, are so thin, they're happening all at the exact same point, okay? And interestingly enough, this is exactly what happened or almost exactly what happened in October of 1987 on Black Monday with what was called portfolio insurance, right? And all portfolio insurance was almost identical to what low vol trade is. It's a positive feedback loop which drove stocks up, and it turned into a negative feedback loop, which we're seeing today, bringing stocks right back down once the inputs were reversed, which again is identical to what we're seeing play out. Okay. All right. So look, make sure you hear me here, or hear me out here. I'm not saying that this is all going to come crumbling down tomorrow like it did in 1987. It could. It absolutely could. We could see a 25% sell-off. We could wake up tomorrow and stocks could be down 25%. Maybe it'll be next week. Maybe it'll be next month. I'm not 100% sure. But I do know that some crazy volatility is right around the corner. Okay, and that's what we can certainly be sure of until these risk parity portfolios are able to reset themselves. So if you like what I'm doing here, you like these concepts, like understanding risk parity, understanding how volatility and correlation play into the overall market, and what's triggering the selling. That's what I'm doing every day over at the Patreon page, and I pair that with Elliott Wave to try and map out the highest probability path forward. So if you like this kind of insight and research, make sure you check out the Patreon page, patreon.com/CannonMA. I post multiple updates there each week, where I cover almost every major asset class, and I do it from both a Elliott Wave perspective and a global macro perspective. It's only $29 a month. I post every trade I make. I show my portfolio during every update. And I have a consistent track record of beating not only risk parity, but the market as well. So I always think there's some great value there for anyone who is active in the markets and wants to learn more and be more engaged and really understand what all the major factors are and what all the major players are in the market to just be a smarter trader and more successful trader. So, all right, I threw a lot your way, so if you have any questions, please leave them in the comment section below. I'll do my best to answer them, or maybe approach them or talk about them in a upcoming video. But until next time, good trading, everyone, and I'll see you then. Bye-bye.